Same interest rate. Same loan. Same house. And your mortgage payment went up anyway. Almost every homeowner with a mortgage eventually gets a letter like this. Most people panic when they open it. They call their bank convinced something is wrong. Convinced their rate quietly changed, or someone made a mistake. Usually, nobody made a mistake. There is also a hard cap on how much extra cushion your lender is legally allowed to hold on top of your bills. Almost nobody checks whether their lender is actually staying under it. I will show you exactly what that letter means, and the one thing you can actually do about it, before we are done here. Here's why this catches people so off guard. A fixed-rate mortgage is supposed to be the predictable one. Same payment, same number, for 30 years. That is the entire pitch. So when the payment moves anyway, it feels like a betrayal. Like the one certain thing in your budget quietly stopped being certain. Some people assume the bank is padding fees. Some assume their credit tanked. Neither is usually true. A few even assume the letter is a scam and ignore it completely. That is the worst option of all, because the shortage does not go away just because you did not open the envelope. The real reason has nothing to do with your rate, your credit, or your bank quietly changing the deal. It is two other bills, rising faster than almost anyone is tracking. Bills you agreed to pay the day you signed your loan, even if nobody walked you through exactly how they get collected. So let's open the letter. What is actually going on? Most mortgages include something called an escrow account. That is just a separate holding account your lender uses to pay two of your bills for you. Some places call it an impound account instead. Same thing, different name. Per the Consumer Financial Protection Bureau, here is exactly how it works. A slice of every monthly payment you make does not go towards your loan at all. It goes into a separate account. Your lender uses that account to pay two bills on your behalf: property tax and homeowners insurance. Think of it like a subscription your lender manages for you. Instead of one huge tax bill and one huge insurance bill landing once a year, you pay a slice of each, every single month. It gets folded quietly into your regular mortgage payment, so it never feels like a separate bill at all. For years, that number barely moves. So people stop noticing it is even there. Until one of the two bills inside it jumps. Start with insurance. Per Insurify's 2026 report, the average homeowner's insurance premium rose 12% in 2025 alone, to $2,948 a year. Since 2021, that is a 46% increase. Nearly 3 times the pace of inflation. Now property tax. Per ATTOM Data Solutions, the average single-family home's tax bill rose 3% in 2025, to $4,427. Here is the detail that should actually surprise you. The average home's value fell slightly that same year. The tax bill went up anyway, because of local budget and assessment decisions, not because your house got more valuable. Add those two bills together. Divide by 12. That is the piece of your payment that can move, even though your rate never does. The actual loan part of your payment, what you owe on the house itself, stays exactly the same for the life of a fixed loan. This other piece, riding alongside it, does not. So how does that show up as a sudden jump instead of a slow drift? Once a year, federal rules require your lender to run what is called an escrow analysis. They add up what actually came due in taxes and insurance, and compare it to what they collected from you. If they collected too little, that gap has a name. A shortage. Per the same federal rule, if the shortage is small, your lender can spread the repayment over the next 12 months. If it's larger, they can ask for it as one lump sum, due within 30 days. That is the letter. Not a mistake. Not a rate change. Last year's bills catching up to what you were actually charged. Let's make that concrete. Say your insurance alone jumped by $300 over the year, and your lender did not catch it in time. That whole $300 becomes a shortage. Spread over 12 months, that is an extra $25 added to every single payment, on top of whatever your bills already cost. One more number worth knowing. Lenders are also allowed to hold a small cushion above what they think they will need, in case a bill runs higher than expected. Per that same federal rule, that cushion is capped. No more than 1/6 of your annual escrow bills. Roughly 2 months' worth. Not an unlimited buffer they can pad at will. Digging past the confusing letter and into the actual rule behind it is the whole point of this channel. If that is useful to you, subscribing means the next one finds you before your own letter does. Now the honest part. First, none of this is evenly spread across the country. Per Insurify, states like California are projected to see insurance climb over 15% in a single year. Others see far smaller moves. Your state, and even your county, can look completely different from the national average. A national headline is a starting point for what to expect, never a prediction of your own bill. Second, not every mortgage has an escrow account at all. Some loans, especially with a large enough down payment, let you pay taxes and insurance yourself, directly. This entire mechanism only applies if your lender collects and holds that money for you. If you pay your own taxes and insurance directly, none of this shortage process touches you at all, though the bills themselves still rise regardless. Third, property tax appeal processes are real, but they vary enormously by county, including how long you actually have to file one. I could not verify a single national deadline worth putting on screen. Check your own county assessor's site directly. Do not trust a rounded-off number from anywhere else, including this video. And to be completely direct about what this is. This is general information about how escrow accounts work under federal rule. It is not legal or financial advice for your specific mortgage or your specific bill. Your loan's exact terms, your county's exact tax rules, and your insurer's exact pricing are the only numbers that actually apply to you. This channel has nothing to sell you, and no referral fee riding on which insurer or lender you use. If a shortage letter genuinely does not make sense to you, ask your servicer for the full escrow analysis in writing. It is a completely normal request, not a confrontation. So here is exactly what to do the next time that letter arrives. 1. Actually read the escrow analysis statement, line by line, instead of just the new payment number at the top. It breaks out exactly what was paid in taxes, what was paid in insurance, and exactly where the shortage came from. That is the whole story, printed in plain numbers, sitting right there on the page most people skip straight past. 2. If you're offered a choice, compare the lump sum against the 12-month spread honestly. Paying the lump sum keeps your monthly payment lower, if you actually have the cash sitting available. Spreading it protects your cash flow, at the cost of a higher payment for a year. Neither choice is automatically wrong. It depends on whether that cash is better sitting in your account earning something, or better spent making next year's shortage impossible. 3. Shop your homeowner's insurance before you assume the increase is fixed. Premiums climbed nationally, but they did not climb identically at every insurer. A different carrier, or a bundled policy, can sometimes claw back a real chunk of that increase. It costs you one afternoon of getting quotes, against a bill that repeats every single year you own the house. 4. If your property tax jumped because of a reassessment, look up your own county's appeal window today, not after the deadline passes. It is usually short. Exactly how short depends entirely on where you live. 5. If you're now years into the loan with real equity built up, ask your lender whether you can drop the escrow account entirely. On most conventional loans, once you're below 80% of your original loan amount versus your original home value, that is often on the table. You would then pay taxes and insurance yourself, directly, on your own schedule. Ask your specific lender what their own requirements are, since servicers do not all apply this identically. So, quickly, what actually happened when that letter showed up? Your rate did not move. Your loan did not change. 2 bills your lender pays on your behalf, property tax and homeowners insurance, went up faster than what you were collecting for them. Insurance rose 12% in a single year. Property tax rose 3%, even as home values dipped. Add them together, divide by 12, and that gap is the letter in your mailbox. knowing that before the letter arrives beats being blindsided by it. If that is worth something to you, subscribing is the whole ask. And if you have gotten one of these letters yourself, tell me what caused yours in the comments. Insurance, tax, or something else entirely. It helps the next person open theirs without panicking. See you in the next one.